Hello everybody, I'm Mark Weissy,
And this is Gonzalo Tranowski.
and we're here with Maple Capital Partners discussing a topic that is near and dear to us: how to vet deal sponsors. That is, multifamily syndicators and operators that bring you deals. The number one rule in multifamily syndications is that you bet on the jockey more than the horse. What I mean by this is when you're investing in deals, you want to look first and foremost at the one who is running the deal sponsor. Before you even look at a deal, you need to thoroughly evaluate that operator, their credibility, track record, and more importantly, their integrity. Good operators can make a bad deal into an acceptable deal, and bad operators can make a good deal into a bad deal. Trust us, because we've seen this firsthand.
Now, a word of caution. Vetting the sponsor is an involved process. It will require you to roll up your sleeves and do some research on your part. However, time spent upfront performing due diligence will save you headaches and possibly a ton of money down the road.
Lastly, the sponsor-investor relationship is much akin to a marriage. You're entering a long-term relationship, partnership, with a sponsor in which you invest in their deals. Savvy investors understand this and approach that process of vetting a sponsor just like dating. It takes time to get to know them and build trust. Don't rush it.
Now, folks, with those points in mind, we're now going to give you some of our top considerations and questions that you need to be asking the sponsor that you're looking at before putting any single penny into a syndication deal.
The first consideration when vetting a sponsor is urgency. Are you sensing a feeling of urgency when speaking to the operator? Are they rushing to get you into their deal before even getting to know you? As mentioned earlier, this is a long-term game. A relationship with a good sponsor takes time to establish, and it takes time to get to know you, learn about your goals, your investing background and experience, and whether or not real estate syndications are even right for you. If an operator is trying to get you into a deal when they first meet you or before you've developed a solid relationship, that is not a good sign, and they may even be in violation of securities regulations.
Now, just like anything else, what is this sponsor's track record? How many years have they been syndicating real estate deals for? How many doors or dollars in assets do they have under management? How many deals have gone full cycle? What were investors' return on those deals? Can you get a copy of their past deals? Things like budgets, projected returns versus actuals. This is important information to acquire in order for you to review and vet a sponsor. A point here. Not all syndicators are going to have been in business for over 20 years. Now, this doesn't necessarily mean that they're automatically written off. If they don't have a deep track record, are they partnering with someone who has experience? If that's the case, what do they bring to the table and what makes them uniquely suited for this responsibility? Now, along the lines of track record, you want to find out about the not so glamorous experiences they've had and what they've learned from them. What was their worst experience in investing? How did they overcome it? Have they gone through a recession before? How did they react and what lessons did they carry forward? Asking these questions gives the operator a chance to disclose how they've responded to adversity and hardship in the past. Now, we all face tough situations from time to time. It's just life, right? But it's about how we respond to the situations and what we learn from them and carry them forward. So I'd be very skeptical if an operator didn't have a ton of war stories and the scars to prove them.
Yeah, in addition to that, we look at local market expertise. How long has the operator been investing in the target market? Ask them what they like about the market to get their perspective on why they're investing there. What other assets do they own in the nearby area? And who are their local market partners? So that might include property managers, brokers. You want to be sure that this operator knows this market like the back of their hand and that they have the right team in place to support this endeavor. Now, the next consideration that we have when vetting a sponsor is this idea of social proof, which basically means, does the operator have a presence within the investment community? Specifically, are they known throughout the multifamily community as an operator? Also, do they have a professional-looking website? I know on my own behalf, I wouldn't buy anything today that's marketed by a brand that doesn't have a professional-looking website. So why would investing 5 or 6 figures possibly into a multifamily asset be any different? Besides having a website that looks professional, you also want to make sure that the sponsor has a thought leadership platform, which means that they're building authority. They put out valuable content on a continuous basis. You basically want to make sure that this operator has a established investor base, and a reputation at stake.
Now, folks, make sure you do your homework. Don't just go to the sponsor's website and check that box. Part of social proof is getting testimonials, aka referrals. Do you know others who have invested with them? How have these investors' experiences with the sponsor team been? Try to ask about deals that they've invested in and cross-check those answers against the responses from other referrals. You can't be too careful these days, and then the last thing you want is to get referrals from the sponsor's brother or family.
So this next set of steps are really what I would classify as more forensic, hands-on due diligence steps that you need to do on any sponsor before investing a single dime.
Now, background checks on both individuals and their syndication business. Now, before running the background check, ask if there's anything you want to be made aware of from the sponsor. A lot of times they will divulge information if they have nothing to hide. Background checks aren't always foolproof, and the sponsor might give you more info than you'd get out of a single background check.
You also need to look up their LLC on sites such as Open Corporates. You need to make sure that when they told you that what their track record is, that their LLC has been in existence at least since then.
You want to make sure you pull title on a few of these properties that they claim to own to verify that fact. Check the purchase date on record versus the sponsor's story. You want to also conduct an on-site property visit on some of these assets.
Also, you want to speak with some of the sponsor's service providers on previous transactions that they've done. This could mean property managers, lenders, insurers, GCs, brokers, etc. They can all be invaluable resources in terms of vetting a sponsor. You want to ask them tons of questions about the sponsor in terms of how they handle themselves and manage these assets. The next consideration we have is skin in the game. What we mean by skin in the game is the operator investing their own capital in the deals that you're investing in? We want to make sure that the operator has their own capital tied up in the asset, because if things go south, they'll be less likely to abandon the investment.
Attitude and transparency. The deal sponsor is a steward of your capital. They should treat you with the respect and care of someone who is entrusted with the serious responsibility of managing your hard-earned money. Now, if you ask the sponsor for a report, they should make sure they make their best effort to provide it to you. If a sponsor who is curt, refuses to take time to provide information or answer any of your questions, as well as rush you, or is unresponsive, it is one of those signs that you want to stay away. If they are impolite or downright uncooperative, word of advice, stay away and look for the next sponsor.
Lastly, and perhaps most importantly, is evaluating the operator's moral character. That is, their integrity. It's so important. And to illustrate that point, I'll give a short anecdote that Warren Buffett uses to pick his own managers. He says that he looks for the qualities of integrity, hard work, and intelligence in anybody that he hires. And without integrity, the other two don't matter. When you're evaluating a sponsor, you want to figure out what their core values are. Do they align with your behavior and your background? And you want to make sure that their disposition doesn't give you pause. You want to make sure that you trust your gut in evaluating a sponsor, in short. It's often steps ahead of your mind. If you feel uneasy around them, or you feel as though your personalities will clash, then you may want to move on. This business is a long-term one, and you don't want to be tied financially to people you don't align with, either ethically or personality-wise.
Thank you, and we hope you'd found value in this video.
And this video and the framework that we laid out within it are some of the same hard lessons that we had to learn investing in deals as limited partners ourselves. As we always say at Maple Capital Partners, it's better to miss a great deal than to be invested with a partner who you're not aligned with.
On behalf of Maple Capital Partners, be kind, be charitable, and invest wisely.